Now, a sales type lease, like I was saying before, the lessee, the party that is leasing, is much more simple. It's either an operating or a finance. Not that this is too difficult, but from the lessor's perspective, the party that owns the asset and is letting the other party use it, it's either operating or it's financing. And then under financing, you either get sales type or direct. And we will see those two methods. Sales type, I'm really going to talk about more because that's much more common. The lease classification tests for the lessor are identical to the tests used by the lessee to determine classification as financing or operating. As I just said, the lessor has transferred control of the right of use asset and has a sales type lease if the lessee takes ownership or consumes a substantial portion of the underlying asset over the lease term. That is also, right, that's our test. That's the whole point of our test, why we run through it, right? It should make sense now. If you're going to essentially own it, you might as well classify it as having owned it. If the lease does not transfer control of the asset over the lease term, the lessor will use the operating approach in accounting for the lease. Now, here we go. Sales type lease accounting, measurement, and presentation. For sales type lease, the lessor accounts for the lease in a manner similar to the sale of an asset. The lessor generally records a lease receivable and eliminates the leased asset, well, because they're essentially giving it up. And the lease receivable for EP Corp, that's from the other example, or in this case, this would be from the other party, is computed as shown. We take our lease receivable. That's going to be the present value of rental payments plus present value of guaranteed and unguaranteed residual values. Essentially, right, this is just saying it's a sale. It is recording this lease as a sale because that's what it really is. Last example here. Now, this is a sales type lease going back to EP Corporation and Alpha Corp. This is the same exact question as the finance lease we started with. So don't worry, like this is the same information, same everything. But now this is from the lessor's perspective. And from the lessor's perspective, it is a financing lease with the subcategory of sales type lease. Again, there is the direct method. We're not really going to worry about that too much. This lease type is the most common type for the finance lease. Only the lessor breaks out between sales type and direct. Again, this is from the lessor's perspective. Let's run through it. We went through the information before. Feel free to read through it again. I'm not going to read through it again since we saw it before. And then I'm going to jump right into it. Okay. Well, here we are. So we take the fair value of the leased equipment, right? What are we doing here right away? Well, we're trying to determine the lease type. Okay. So we're trying to determine the amount to be recovered by the lessor through lease payments. We're trying to use our tests to determine the lease classification. And we'll see here, well, the classification for a finance sales type lease. And I guess we could jump here. So the lease meets the criteria for the classification as a finance or sales type lease because the present value of the lease payments is equal to the fair value of the asset. And that's what we were determining up there. The lease term is equal to the economic life of the asset, right? So right here, we have how long is the period? Well, it looks like the economic life of 5 years, and it looks like the lease term is 5 years. We have 5 years and 5 years. So that's where that criteria is met. And then we're determining the present value factors here. $100,000, present value of the residual value. So we're essentially subtracting out salvage value, but we have to use the present value factor for that salvage value. We see the salvage value is $5,000. Residual value also means salvage value, synonyms right there. And the point being that at the end, right, the end of the lease, this is essentially the value of it, just like you would determine the depreciable base for something. It's the value minus the salvage value, but in this case, we're just factoring the salvage value. All right. So now if we take into account these lease payments, right? Remember this $20,711. This is the amount we were using for our lease payments in the previous question. And this is the same question as I was saying. This is a sales type lease. Therefore, Alpha Construction will consume substantially the entire underlying asset over the lease term. Okay. Well, as we were saying before, we deal with our lease receivable. EP Corporation computes the lease receivable as shown below. We have our lease receivable, and that's going to equal the present value of the rental payment. We calculated that is $95,000 roughly, plus the present value of the guaranteed residual value. And wouldn't you know it, that gets us back to our $100,000. Why were we doing this? What's the whole point? Well, we're trying to determine the test here, and 95 is greater than 90% of $100,000, right? 90% of $100,000 is 90,000. So that's essentially our present value test. Now we are accounting for lease receivable and sales revenue. This is a sale, right? It's a financing lease. It's essentially a sale. So that's kind of how we're recording it. Just like you would say AR and sales revenue, cost of goods sold, inventory, same journal entry as if you were making a sale. This is the same journal entry. Nothing different except for a lease receivable instead of accounts receivable. But even that's not really anything too much to worry about, right? So treat this like it's a normal sale. Here is our schedule, right? Here's our schedule, same schedule that we saw before, same exact thing. Let's look at some journal entries. Okay, well, we're still going to record our receipt of our payments because it's like a financing agreement. So you're receiving the cash for this, you're receiving the payments every year. Now, instead of the journal entries for the operating lease, or instead of the lessee's journal entries, these are going to be much more simple. It's like you're just receiving your payments every year. So you're going to debit cash and credit AR, or lease receivable in this case. You are going to increase lease receivable, interest revenue. So you're still getting revenue here, right? You essentially accounted for the principal and all of in the receivables end. But in addition to them purchasing this good for the main journal entry we saw here, we're also making some interest revenue because they're financing it through us. This would be the journal entry for recognizing the interest revenue. Makes sense, right? As the year went on, as year 10 went on, we went from 1/1 year 10 to 12/31 year 10. We have interest that we accrued throughout the period that we are getting in this case because we are the lessor. So awesome there. Now here's the balance sheet at the end of year 10. Lease receivable, this is going to be the $20,711 amount in current assets, because that's what we're getting, right? We're getting payments of $20,711. Part of that is interest and part of that is principal. The non-current assets, that is the rest of the lease receivable that has not been paid out yet. What is the income statement? Well, we record sales revenue because we made the sale, and this is accrual-based accounting. So even though we haven't received all the cash yet, we still record a sale minus cost of goods sold. That's going to give us our gross profit on the income statement. And then we have interest revenue for just this one period so far, just this 1 year. That's how much we can record thus far. All right. Now, year 11 journal entries. Remember, it's paid out on January 1st. We debit cash because we received the cash, again, a cash payment. We are going to reduce our lease receivable by the same amount because it's a financing agreement, right? We're just getting paid out on these different dates. And, well, we do our interest journal entry again, right? We are recognizing that tomorrow we're getting paid interest. And for now, it's lease receivable. I would call this interest receivable. You can call it lease receivable. And then crediting interest revenue. Lastly, here is the journal entry for when the leased asset is returned to EP Corporation. When the sale is essentially complete, we are debiting inventory and crediting lease receivable. Final journal entry here. Good example. So just to recap, we saw 3 examples. We saw the financing lease from both the lessor's perspective and the lessee's perspective. So the operating lease from both perspectives. And I think that's a pretty solid way to go. I think you've seen a lot. Take it all in. Go through it again. This was a doozy, right? There's a lot going on.